Marc Ostwald from ADM Investor Services International. With some thoughts this week on this great battle of ESG and pitching it against lived reality at the moment, because I think somewhere along the line, we seem to have been going down an ethical route and forgetting about the fact that there are a lot of practicalities. So my first chart this week is the chart of the Exxon Mobil equity price. As one can see, it's been in pretty bad shape for 5 years. We have recovered somewhat thanks to the rebound in oil prices, but by comparison with a lot of the rest of the equity market, clearly it's under a cloud. And it's not really surprising if we're moving away from hydrocarbons. Why would one want to be particularly overly invested in the hydrocarbon sector, even if it is continuing to diversify? But I think the key point here is just how much this is impacting the other way around. Let's have a look at a US renewables company, one of the biggest. Nextera Energy is the next chart. At one point last year, when the Exxon share price was down in the gutter, this was actually capitalized at a higher level than Exxon Mobil, which, with all due respect to Nextera Energy, I think is showing just how bad these flows are. And I think the key point here for people to understand is if we're actually going to have a lot of sovereign wealth funds, which are huge equity holders, basically being driven out because of ethics and ESG considerations out of the hydrocarbon sector into the renewable sector, we actually are going to end up with probably having a bit of a financing problem. Now, Nextera is a broad renewables company, but I want to have a look at one specific thing, which obviously is a big hope, and that's hydrogen production costs as estimated by the Hydrogen Council is my third chart. Now, make sure you keep an eye on the bottom because basically those bottom lines are the ones where hydrogen production costs become competitive with hydrocarbons, and this is green hydrogen as opposed to grey hydrogen, which one can see the price of down the bottom also. And we're looking at a time frame where it's really a long way away. Obviously, there are adjustments here to be made. If we put carbon taxes on grey hydrogen and other things, obviously they would become more competitive. But those are taxes, and those are not necessarily the best way of going around of incentivizing this. But I think the important point here is it's unlikely to be competitive until about 2030. And we haven't even started to consider about the fact that we need the infrastructure and the capacity to produce a lot of energy, which is now to displace hydrocarbons from the whole picture. And as one can see, basically from the way that coal displaced wood and then oil displaced coal, these things don't take a matter of years, they take decades, if not centuries. So we need to bear that in mind. So let's move on to my fourth chart. What do we actually need to start getting the capacity there? Well, there are two elements in here in the alternative energy space, particularly related to vehicles. One is rhodium, and this is a price chart of rhodium. As one can see, it's risen spectacularly. We did have a bit of a downturn at the beginning of last year, and that's mostly to do with electric vehicles. But as one can see, spectacular rise and seemingly relentless as we go into more and more fad of renewables. My fifth chart is Iridium, and this is primarily to do with Iridium being a key part of hydrogen fuel cells. And as one can see, the price there has gone completely parabolic, and it obviously starts to make the cost of production that much more difficult to attain. My sixth chart is good old-fashioned oil, WTI oil. And I mention this for the simple reason, if we are actually going to an era where we don't want to finance hydrocarbons because we feel it's unethical, and we don't want to finance further research or search exploration of oil, then we are going to find that there is a shortage of oil. And we've already had underinvestment in future oil supply for about 5 or 6 years since the first oil price crash back in 2014. So unless we're very careful here, we actually might create a huge spike in oil prices, which will only make life even more difficult for people already facing rising costs, particularly in the food arena. This is not clever. This needs to be managed much better by governments. And that's my thought for today.